Hi everyone, in this video I want to solve a question on personal finance in which we are going to use the formula for an ordinary annuity. So let's take a look at the question. A 25-year-old employee plans to retire at age of 60 and wants enough savings to live to the age of 90. At present, the employee has zero retirement savings. The employee currently earns after-tax income of $70,000 per year. The employee anticipates a 5% return on investments in a retirement account. The employee will begin saving for retirement, making the first payment into the retirement account in 1 year, making annual payments until retirement, and then drawing down retirement savings in equal amounts at the end of every year thereafter. If the employee sets aside 15% of the employee's after-tax income each year, what annual cash flow can the employee expect to receive in retirement? You are assuming that we assume that cash flows are in real terms and the rate of return on your investment is 5%. Okay, so what this question is telling you and what it is asking from you. So in this question, you have an individual who is 25 years old and he wants to start saving money in an account from next year, from when he is 26 years old. So from next year, he starts to saving money till he gets to 60 years old. And after that, after getting to year 60, he wants to start to withdraw money from his account till he gets 90 years old. So in fact, what we have here in this question is that from year 26 till year 60, this individual will invest a fixed cash flow in an account, and that account will pay him a 5% return. So these cash flows that he will invest from year 26 till year 60 will grow at 5% rate of return. Then when he gets to year 60, he retires and he starts to withdraw money from his savings account till he is 90 years old. Okay? So in this question, in fact, what you are asked to find is that you are asked to find this cash flow that you can start to withdraw when you get to year 61 till year 90. So the cash flow that you're going to withdraw each year from your account after year 60 is always fixed. So because it is mentioned in the question. So you withdraw in equal amounts, okay? So these CF1, CF2, and CF3 are all fixed here, are all the same. Okay, so you are 25 years old, you start saving. How much do you save? It is mentioned that you save 15% of your income. So your amount of money that you're going to save is going to be 15% multiplied by your annual income. So you're going to save $10,500 each year from year 26 to year 60. So how many years will you save your money? You will save your money for 35 years, right? Because it is equal to the last year of your savings minus the year that you begin, which is year 26, but then you should add 1 to it, so it becomes 35 years. And then how many years you want to withdraw money from your account from year 60 to year 90, right? So you start withdrawing money in year 61 and you will continue till year 90. How many years is that in time period? There are 30 years, okay? There are 30 years. So this is what we have. So what we want to do, we want to see that in this question, we want to see that if I invest this fixed cash flow of $10,500 each year, from year 26 to year 60, and I receive a 5% rate of return or interest each year on the amount of my savings, at the end of year 60, how much money I will have in my account. And that money can support how much with annual withdrawal for 30 years after that. So in other words, you want to find the future value of your initial, all of your investments from year 26 to year 60. But because in order to find the future value of each cash flow, you should find the future value of each cash flow and add them together, and it will be very time consuming because you have something like 35 time periods. So what we do, we use the formula that we had for ordinary annuity. So we have a formula for the present value of an ordinary annuity. As you see, we have an ordinary annuity here because the cash flow that you invest each year is fixed at $10,500, right? And the number of periods that you save is finite, it's 35 years. So you have an ordinary annuity. You can find the present value of this ordinary annuity using the formula that we have. Very easily, you can find the present value in year 25. And then by using the formula for future value, very easily you can transfer this present value from year 25, right, to future value in year 60. So in this way, the number of calculations that you have to do will go down. So let's do that. Let's first find the present value of retirement savings. So I use the formula for the present value of an annuity. So as you know, our cash flow, which we invest each year, is fixed, is $10,500. We divide it by our discount rate or rate of return, which is 5%. Then we multiply it by 1 minus 1 divided by 1 plus your interest rate, which is again 5%, and then you close the parentheses and you send it to the power of t, which is the number of periods that we have in this annuity. We have 35 periods from year 26 to year 60, and then we close the parentheses and we click enter. So as you can see, this is the present value of your investments from year 26 to year 60. But now, what do we need? To find? We need to find the future value of this amount in year 60. So we want to find the future value of all of our savings in year 60. So in order to do that, just consider your present value at today multiplied by 1 plus your interest rate, your rate of return on your savings account, which is 5%, to the power of number of periods that we have. So how many periods do we have from 25 to year 60? We have 35 periods. So in this way, we calculate the future value of investments in our savings account. After finding this future value, this is showing you the amount of money that you will have in your savings account in year 60. So after year 60, you want to start and withdraw a fixed cash flow each year from your account, and you want this the value of cash flow to be such that you can withdraw that cash flow for 30 years from year 61 to year 90. So in other words, this $948,000 is the present value of another annuity, annuity from year 61 to year 90. And in that annuity, you start to withdraw money from your account and at a for a fixed cash flow. So let's find, so in other words, now we want to find C in this formula for ordinary and annuity, in which the present value of your ordinary annuity is $948,000. So let's use the formula that we have in order to find the cash flow that you can start to withdraw from your account at year 61. So this cash flow will be equal to present value of your annuity multiplied by your discount rate of 5%, and then you should divide that by 1 minus 1 divided by 1 plus your interest rate. Again, your rate of return is 5%. And you close that and you send it to the power of number of periods that you have. In your second annuity, number of periods that you have is 30 years. And then you close the parentheses, okay? Okay, then you click enter. So as you see, the amount of cash flow that you can start to withdraw from your account from year 61 is exactly $61,692. So this is exactly what we were asked to find in this question. What annual cash flow can the employee expect to receive in retirement? In order just to illustrate what what we really have in this question, I made a table. So this table shows you what is happening to your investment from year 26 to year 60, and after that what happens when you start to withdraw cash from your account. So let's take a look at that. So you start to save in year 26. At the beginning of the year you have nothing in your account, so your opening balance is 0. And because you didn't invest anything, you don't earn return on your account. So how much do you invest in year 1? At the end of the year, you invest $10,500. So the closing balance will be only $10,500. When you go to year 27, what you have, your opening balance will be the closing balance of last period. And how much return will you earn? You will earn 5% on your account. This 5% return is mentioned in the question. So how do you calculate this return? You just multiplied your opening balance with this interest rate that you earn on your account, and you click enter. Okay, so you see the number is exactly the same. And then again, at the end of the year, even you are 27 years old, you invest another $10,500. So your closing balance will be the summation of your investment and how much interest you earned on your account and your initial investment. Okay, so exactly if you click on this cell, you see that your closing balance is the summation of your account balance at the beginning of the period, plus the interest that you earned during the period, plus your investment at the end of the period, and you click enter. Okay, so if we continue in the same way, and as you can see, each year you invest a fixed amount, you invest $10,500, and you do that till you get to 60 years old. Okay. And in the same way, you can calculate the opening balance in each period. Opening balance in each period is the closing balance in the period before. And you can calculate the interest rate in the same way. Just multiply your opening balance with the 5% rate of return that you receive on your account. And then the amount of investment in each period is fixed, is $10,500. So if you do all of these calculations, what you will see that is that when you get to 60 years old, this is very interesting. The closing balance that you will have in your account, the closing balance that you will have in your account is exactly $948,000, which is the present value, which is the value of your savings that you calculated in year 60 is exactly the same amount, you see? So the formula that we had gave us exactly the same thing when you create a table. Then you start, after year 60, you start to withdraw $61,692 each year, you see? So you are withdrawing the same amount from year 60 to year 90. What happens after that? So in year 61, your opening balance is the closing balance from last period, and then you earn an interest on your opening balance, which is 5% multiplied by $948,000, and then you withdraw $61,692 from your account. So the closing balance will be the summation of all these three cash flows that you have. If you continue this way and continue to withdraw $61,000 and $692 every year, you observe that when you get to year 90, the closing balance of your account gets zero, will be equal to zero. In other words, you have withdrawn all of the money that you had in your account, in your savings account. Okay, thank you very much. I hope that this example is clear for you. So in this example, which is regarding the topic of personal finance, we use the formula for ordinary annuity. Thanks and bye.